What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about Nvidia stock. I'm going to be going over my updated intrinsic value on this company. So I am about as ready as I can be mentally for all the comments that are going to start hitting this video. So I also want to run a reverse discounted cash flow model. So very quick reverse DCF to better understand that, okay, today Nvidia is trading at just over $400 per share. What needs to happen in the future in order for Nvidia to justify its valuation today? So that's a reverse DCF that I want to run, and we'll again continue with our discounted earnings multiple model to better understand, okay, expected price to earnings, expected growth rate, what's going to be the intrinsic value based on that as well. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below. 2 more days for that 16% annual discount that you can take advantage of after October 31st. It is going to expire. And I also want to mention the educational courses, fundamental analysis, technical analysis, options trading, bundles. Everything is 50 to 60% off on Halloween. So coupon code is going to be Halloween. And that also does expire after October 31st at midnight. So link's going to be down below. Would love to have you on board. You get lifetime access to everything, and every new course that's added, every new additional lectures and videos within the course curriculum is going to be accessible for you for free, and you can download a lot of these spreadsheets and of course download a lot of informational material and documents from the course curriculum as well. So link's going to be down below, and again, we'd love to have you on board. So this right here is the numbers for Nvidia, right? So I've already got a spreadsheet which I have broken down in my previous videos. What you'll notice is that, you know, Nvidia 2024 expectations are pretty sky high at over $54 billion. That's the revenue expectations. And what you'll notice is that over the last, I think this is 16, 17 years, or actually a little bit 20 years total, 20 years, Nvidia has been able to grow revenues by almost 19%. That's actually quite phenomenal. Not a lot of companies can say that their revenues have grown at almost 19% in the last, 20 years. If you take a look at gross profit, that's grown at 23%. So very nice. And expectations are $33.5 billion with a 62% gross margin for the company, and operating income expected at just over 13.5 billion. And the reason I'm going over 2024 numbers is because we've seen such an acceleration in the last 1 year for Nvidia because of artificial intelligence. Revenue has more than doubled, gross profit, more than doubled potentially. The company is going to report earnings here very soon, so we're going to plug in those final numbers once the fiscal year 24 is over. So potentially has more than doubled. Gross profits up 62% margins here with the 33.5 billion, again more than doubled from 15.3 billion at the same time last year. Operating income also 13.5 billion, more than doubled, right? Almost tripled, 25% operating margin, and we got net income at $22 billion expected. That's right, $22.7 billion expected in terms of that net income. And the earnings per share expected for Nvidia for this year are going to be a little bit over $10 per share. So if you come over to Nvidia's earnings forecast, again, just to make sure that we have the numbers right. So we're going to come down a little bit. Fundamentals, earnings, expectations here. You'll notice that the expectations are just over $10.73 compared to $327, $334 last year. That's almost a 300% increase, right? Tripling in terms of earnings per share this year, and the expectations are for them to continue to accelerate with 2024 70% increase, and then slowing down to about 40% and then slowing down to 20%. So that's the insane expectations, right, for Nvidia's earnings in the future. So that's the 22.7 billion. Shares outstanding have basically been flat. So if you take a look at the last 20 years, they haven't really done a lot of share buybacks or issuance, 0.1%. That's pretty nominal. And we got earnings per share, again, like I said, $10.57. 2023 was a little bit over 334 actually. So this should really be about a 200% increase, or almost 3 times increase. EBITDA 21.6 billion. And everything is phenomenal, right? So cash debt, pretty good. Net debt, current ratio solid. Free cash flows at over 16.2 billion is what the expectations are, with a 30% free cash flow margin. So knowing a lot of these things, right? Knowing what we know about Nvidia at the moment, and I can update the market cap to just about $1 trillion right now. We are looking at the company to be right now close to valued at, I think that should be good. Close to valued at around 18.5 times sales, 44 times earnings, which again is not terrible for a super high growth company, 61 times free cash flow, and enterprise value to EBITDA trading at 46. So what I want to do is I want to understand, okay, Nvidia today, $1 trillion market cap, a little bit over $400, $409. Is this a buy, right? Is this a buy today? Like, can I actually go out there and I personally can buy Nvidia? Can I do that? What are going to be the expectations for the future that Nvidia would need to hit, right? So we're kind of doing this in a reverse manner. In the past, you guys have seen me kind of forecast the growth, forecast the multiple, and then figure out, okay, what's the intrinsic value and where I'm going to be buying. But in this reverse model, what I'm basically doing is I'm kind of putting Nvidia as a buy already for me, but then I'm also kind of measuring my expectations and what Nvidia needs to do in the future to justify today's valuation. So that's what we're going to do. We're going to do it both ways, but I think the second analysis is going to be very interesting. The reverse model is going to be a lot more interesting for us to basically realistically kind of understand, can the business actually achieve that? So in order to do that, I've got over here the expectations, okay? So analyst estimates 2024, revenue of $54 billion. And 2029, they're expecting $140 billion. In 2033, they're expecting just shy of $200 billion. It's a 5-year CAGR of 21% and a 10-year CAGR of 15%. I'm going to create another column over here, which is going to basically be the actual CAGR for the company from their previous numbers. So if you take a look at revenues, they have grown by just under 19%. That's a 20-year CAGR. So let's just put that down here. 20-year CAGR actual was just under 20%. So I'm going to go ahead and put down 20% over here. Now, next comes EPS, earnings per share. $11 per share expected, so just shy of $11. These are just rounded up to $30 in 2029, and then $41 by 2033. That's a 5-year CAGR of 22% and a 10-year CAGR of 16%. And then we can put down the actual number over the last 20 years. So if you come over to earnings per share, this right here is the number. We're looking at 33. We're just rounded up to 34% has been the growth over the last 20 years. And finally, we come over to free cash flow. $19 billion expected this year, which is going to grow to over $56 billion, and that's a 35% margin. Although I think free cash flow, I'm definitely being optimistic here for Nvidia. So if you come over to free cash flow, the expectations are actually 16.2 billion because they're expecting 30% margins. Let's see what happens if I do 35%, then of course we're back up to almost 19 billion as I showed you in the other screen. But 30% is the expected number for this year, but I want to be optimistic in this scenario with 35% margin at $19 billion, and $56 billion is going to be the 2029 number, and then $89 billion in 2033. That's going to be a 24% growth and a 19% growth. And in the past, the free cash flows have grown by, again, 34%. Very similar to the net income. Now, free cash flow margins, the way I've got free cash flows over here is simply taking into account the margins. So that 56 billion, 89 billion is nothing but off of the revenue number and simply accounting for the margin expansion of 5 percentage points. So, if in the future Nvidia becomes more profitable, we're going from 35 to 40 to 45%, right? Those are going to be the margins, free cash flows for the company. And that is how I'm getting my free cash flow expectations for Nvidia. Okay, so now we've got the numbers to play around with, right? So 5-year CAGR, this is analyst, right? So this right here is the analyst estimates. Just gonna move that down here. Just gonna make it a little bit bigger. So this is the analyst expectations. This is also analyst expectations, and this is the actual, right? So we're just gonna move that over here. This is the actual. For revenue, earnings, and free cash flow. Now we can move over to some forecasting, okay? 5-year, that's what we're going to forecast. We're going to forecast for the 5 years, and revenue expected at 21%, earnings at 22%, and free cash flow at 24%. In the past, in 20 years, they've grown revenues at 20%, net income by 34%, and free cash flow by 34% as well. So let's just run through our discounted cash flow first, okay? To better understand, okay, what does Nvidia need to do in order to justify today's valuation? So we already got Nvidia over here, trailing 12-month free cash flow. We're going to put in 19 billion. That's going to be that number. So again, this is based on a 35% margin, which I doubt Nvidia is going to be able to do. I think it's going to be closer to $16-17 billion. But I'm being optimistic here. Let's go with 35%. Year 1 through 5 growth rate, right? So what is going to be that growth rate for the next 5 years for Nvidia? And this is where we come back to this analysis over here. In the past, they've grown 24% on a 5-year basis, or that's what the analyst expectations are. In the past, they've grown by 34%. So let's go ahead and put down 30% growth, right? 30% I think is a very, very reasonable number for free cash flow growth. And you can see that this is all the free cash flows, going from 24.7 all the way up to over $70 billion for the company. Discount rate, of course, we applied 12% here. Now, terminal value is basically what is going to be that free cash flow growth over the next for the life of the company. So after year 5, from year 6 onwards, all the way through the life of the company, what's going to be that terminal growth rate? Now, this number needs to be somewhere between 2 to 4% because, most companies can't grow forever at 30% or 20% or even 10%. So I think it needs to be in the low single digits to make the analysis a lot more sense and more realistic. So I'm going to go with 3% here for Nvidia, and then look at what happens, right? So with no margin of safety and no share dilution, because the company hasn't really bought back any shares in the last 20 years, and accounting for no margin of safety, Nvidia today needs to, and look what happens if I change the free cash flow expectations to the actual potential number of 2024, which I think is going to be closer to 17 billion. So let's just do 17 billion over here. The fair value ends up at $220. So that basically means that Nvidia needs to grow free cash flows at over 30% for the next 5 years, discounting all those future cash flows back to present value at a 12% required rate of return and a 3% terminal growth rate. And even then, Nvidia would be considered overvalued based on its free cash flow growth of 45% would be overvalued, and fair value would be at 220. Now let's try to match these numbers, right? Let's see if we can match these numbers. What is going to be that number looking like? So let's just do 40% growth. Okay, so we're getting close, $310. Let's just say 50% growth. There we go. So now we're at 6% undervalued, meaning the estimated intrinsic value is at 429 and the price per share right now in the market is 405. Maybe we can go a little bit lower, 48%. There we go. Perfect. So now the intrinsic value is equivalent to the actual share price. So what does this analysis basically means? That simply means that, okay, if I wanted to buy Nvidia today at $405 per share, and get a 12% return over the next 5 years, because that's a market-beating return and that's a required rate of return I've put in over here, Nvidia would need to grow their free cash flows by 48% every single year for the next 5 years. Is that possible? I don't know. Is that going to happen? I don't know. That's part of the analysis, right? But it's possible, but how probable is it? That's the real question that I think most people need to ask themselves at $405, $403 Nvidia today. Is it possible for Nvidia to grow at 48% free cash flows every single year for the next 5 years? I think it's a really, really low probability outcome because there is going to be competition. I think where there's high returns of capital, where there's high potential for profit, eventually competition does enter the market. And I think 40% is way too optimistic for Nvidia, and of course, I would be closer to 20 to 25%. And look what happens when you drop this down to 25%. The fair value ends up at under $200. And that's accounting for without a margin of safety, right? So 10% margin of safety. And then, of course, we drop down to 166. That's, even lower than what we calculated before. Now, another way to kind of look at this metric, another way to kind of match these numbers is that, okay, we assume that the actual realistic growth rate is going to be 20%, or let's just do 25% over here. But then we start to lower the discount rate, right? So we are willing to accept a lower rate of return in the future. So let's say that we don't want 12%. Let's say that we want 10%. Now look at the fair value, jumped up to 243, right? Again, we're getting closer. Our goal is to match these numbers in a reverse DCF to try to figure out what does the company needs to do in order to achieve or justify today's valuation. So we're getting closer now. Let's just drop down to 8%. Now we're only 14% overvalued. Let's just drop down to 7.5. 4%. Let's just drop down to 7%, and now it's 9% undervalued. So maybe 7.25% is a reasonable discount rate, and there we go. Now it's close to the current market price. So basically what this means is that, look, Nvidia, if you believe that the growth rate for free cash flows for the next 5 years for Nvidia is going to be 25%, far more reasonable than the 48% that we analyzed earlier, so far more realistic and more probable, is going to be a buying opportunity today only if you are looking to make a little bit over 7% per year over the next 5 years, which obviously is lower than the market-beating return is lower. And I would even argue, considering where the treasuries are right now, a 7.25% is significantly worse on a risk-adjusted basis than a 6-month bond, for example, or a 1-year bond or 1-year treasuries, right? So this exercise really helps us kind of put things in perspective a little bit better, and understand, okay, what is it that the company needs to do in order to justify today's valuation? Are we giving up the return, or does the company need to be growing at a very significant rate? And unfortunately, Nvidia at $405, as great of a company as it is, as fantastic of a business it is, it's basically priced for perfection, right? That's what's happening at the moment. So let's go back to our different model. This dividend, not the dividend, but the discounted earnings multiple model. So trailing 12-month net income. So we are looking at a net income of about $41 is going to be that EPS, $30. So net income is going to be at close to 22.7. So let's just round it up to $23 billion is going to be that number. So we're going to plug that in. Net income growth. So EPS expected to be growing at 16% over the next 10 years, 22% over the next 5 years, and 34% over the last 20 years. But like I said, I'm going to be more conservative here. I'm going to go with 20% growth rate and about a 25 times expected multiple, 12% discount rate, 10% margin of safety, 0% share buyback, and we're sitting at just under $300 per share, which actually is not bad. It's not bad. I mean, this is based on an earnings model. It's not bad. $295, I think, is going to be that intrinsic value for Nvidia based on the discounted earnings multiple model. That's going to be this over here. 20% growth in net income over the next 5 years, I think, is somewhat reasonable with a 25 times PE multiple, 12% discount rate, 10% margin of safety built in, and we're looking at sub $300 per share for the company, for Nvidia. And this right here obviously is a little bit different type of analysis, but if I do it in a different way, not the reverse, but the regular way, free cash flow is going to be 17 billion. We expect, let's say, 20% growth in free cash flows, and then 12% discount rate, and then of course 3% terminal growth rate. And discounted cash flows are more brutal than earnings models, right? So we have to understand that, okay, this is going to be a lot more brutal analysis on the free cash flows compared to the net income. So that's where we are with the analysis here. I would, sub 300 is something that I would be paying attention to for Nvidia, but right now it needs to kind of hold that $400 level very, very much, because that's an important support level to watch for this company. If it ends up breaking down, of course, we're looking at this sort of a gap that it may need to fill eventually. And then, like I said, sub 300, we're going to be looking at somewhere around here. That's going to be in line with this previous resistance, possibly acting as a new support in case Nvidia comes down to that level. We're going to be looking at a sell-off of a little bit over 43%, which I guess is pretty normal for Nvidia in its stock performance. In the past, we've seen multiple drops of 30 to 40%. So let me know your thoughts down in the comment section below for this company. As always, if you enjoyed this video, find it helpful, make sure that you drop a like, and don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. 16% annual discount and 50 to 60% discount on educational courses. Coupon code Halloween. As always, happy investing. I'll see you all in the next